$100,000 is sitting in a bank account. It's not doing anything. It's just sitting there, losing value. Inflation is quietly eating it, about 3% a year. Every year it waits, it buys a little less than it did the year before. Now, somewhere across town, a trader is staring at charts. He's watching lines go up and down. He's reading news headlines. He's moving fast. He feels like he's doing something. And then there's the value investor. He's not watching charts. He's reading annual reports from 10 years ago. He's doing math that looks boring. And he's waiting, patiently, quietly, for a moment most investors will completely miss. What does a person with that kind of mind do with $100,000? That's what this is about. Before we get to the money, we need to understand something. Because most people think investing is about finding good companies. It isn't, at least not in the way most people think. You can find the best company in the world, the most innovative, the most profitable, the most talked about, and you can still lose money investing in it. Because investing isn't about finding great companies, it's about finding great companies at the wrong price that the market has given you at the right price. There's a difference between a great business and a great investment. Most people confuse the two their entire lives. Think about the people who bought Amazon in 1999. Amazon was already a great business. It had a vision. It was growing. It was changing how people bought things. They also lost 95% of their money when the dot-com bubble collapsed, not because Amazon was a bad company, but because they paid the wrong price. The value investor understands something that most of the market forgets in its excitement. Price is what you pay, value is what you get. And those two numbers are almost never the same. That gap between what something is worth and what the market is charging you for it is where all the real money in investing actually lives. The value investor's entire job is to find that gap and then wait for it to close. So now, with $100,000, here is exactly how they think. The first thing the value investor does, and this is where they immediately separate themselves from almost everyone else, is nothing. They do not open a brokerage app. They do not watch financial news. They do not ask their friends what's hot right now. They sit. They think. They ask one question before any other. What is this money for? Because $100,000 that you might need in 18 months is a completely different animal from $100,000 you won't touch for 20 years. And the value investor knows that every decision about where to put money starts with understanding the nature of the money itself. This is what most investors skip. They go straight to "where do I put it?" without first asking, what is this actually for? And that single skip costs people more than any bad stock pick ever has. Time horizon is not a preference. It is the architecture of every decision that follows. So let's assume this $100,000 is patient money, money that doesn't need to be touched, money that has the one thing every value investor treats as their greatest asset: time. Now the process begins. Step 1. Build the moat before you build the portfolio. Before placing a single dollar, the value investor sets aside a cash reserve, not because they're afraid, but because they understand something most investors only learn the hard way. The best opportunities in markets come when everything is falling, and the investor who has no cash when prices crash is like a farmer with no seeds when it finally rains. The opportunity is there, they just have nothing to plant. So from the $100,000, roughly $10,000 to $15,000 stays liquid in a high-yield savings account or short-term treasury bills, not earning much, but available, ready, waiting for the moment the market gives a gift. Most investors see a market crash as a disaster. The value investor sees it as a sale, but only if they have the cash to go shopping. Step 2. Understand what you actually own before you own it. Here is where the value investor's process looks almost nothing like what most people imagine investing looks like. There are no charts, no technical patterns, no momentum signals, no social media sentiment, none of it. Instead, annual reports, 10K filings, earnings call transcripts from 3 years ago, balance sheets, income statements, cash flow statements, notes buried in the footnotes that most analysts don't read. The value investor reads a business the way a doctor reads an X-ray. They're looking for what is actually there, not what the market has decided to feel about it this week. They ask, does this business earn real money? Is the debt manageable? Does the company have pricing power? Could I still explain what this company does in one sentence? And then they ask the question that separates value investing from every other philosophy. What is this business actually worth, independent of what the stock price says today? That number, that intrinsic value, that is the North Star of everything that follows. Now let's talk about where the $85,000 actually goes, and more importantly, why. The first allocation, concentration, not diversification. The average retail investor is told to diversify. Spread the money across 40 or 50 positions. Buy an index fund. Don't put all your eggs in one basket. The value investor listens to this advice politely and then ignores most of it. Because diversification is protection against ignorance. If you don't know what you own, you'd better own a lot of things and hope the average works in your favor. But if you do know what you own, deeply, forensically, with real conviction, then spreading your money thinly across 50 companies doesn't protect you, it dilutes you. Warren Buffett said it directly. Wide diversification is only required when investors do not understand what they are doing. So the value investor builds a concentrated portfolio, maybe 6 to 10 positions, each one chosen with the kind of care you'd use if you were buying the entire business, not just a few shares of it. From the $85,000 in play, roughly 60% goes into 4 or 5 high-conviction positions. Businesses they understand completely. Businesses trading below their calculated intrinsic value. Businesses that have what Buffett calls a moat, a competitive advantage so durable it would take a decade to erode. Think a brand so trusted that customers don't even compare prices. A network so embedded that switching would cost more than staying. A cost structure so efficient that competitors can't profitably undercut it. These are moats, and moats are what protect returns across time. The second allocation. The boring businesses nobody is talking about. The remaining 40% goes somewhere most retail investors would never look. Not the companies on the front page of financial media. Not the stocks that everyone at dinner is excited about. Not the next big thing. The quiet ones. The unglamorous ones. The businesses that do something essential and boring and consistent and have been doing it for decades. Insurance companies, industrial suppliers, regional banks with pristine balance sheets, consumer staples businesses that people buy regardless of what the economy is doing. These companies never trend on social media. Nobody makes YouTube videos about them. And that's exactly why they're interesting. Exciting companies attract attention. Attention drives up price. Driven up price destroys returns. The value investor goes where attention is absent, because that's where the gap between price and value is most likely to exist. This is psychologically one of the hardest things in investing. to sit with positions nobody else thinks are interesting, to watch other people make money on things you passed on, to hold boring companies while the market is chasing thrilling ones. But the value investor has studied history, and history says the same thing every decade. The exciting trade almost always underperforms the patient one. The third allocation, the margin of safety. This is the concept that Benjamin Graham, the father of value investing, the man who taught Warren Buffett, considered the most important idea in all of investing. The margin of safety is simple. You calculate what a business is worth, then you only buy it if the price is significantly lower than that number. Not a little lower, significantly lower. Graham liked to see a 30 to 50% discount. If the business is worth $100 per share, he wanted to pay $50 to $70. Not because he thought it was going to crash further, but because he knew he might be wrong in his valuation. And the discount was his protection against being wrong. The margin of safety is not about pessimism, it is about intellectual honesty. The honest acknowledgement that even your best analysis might be incomplete. This is what separates the value investor from the speculator. The speculator says, "I believe this will go up." The value investor says, "Even if I'm partially wrong, the math still works in my favor." So the entire $85,000 that gets deployed, every single position, only gets purchased when this gap exists, when the market is underpricing what the investor has calculated is genuinely there. And if the gap doesn't exist, they wait, sometimes for months, sometimes for years. Most people can't do this. The patience required to sit with cash while markets are moving, while friends are making money, while financial media is screaming about opportunities, is a form of psychological discipline that very few investors ever develop. But the value investor knows activity is not the same as progress. Buying something is not the same as making a good decision. And the most dangerous moment in investing is when you feel like you have to do something. Now let's go somewhere deeper, because value investing isn't really a strategy, it's a philosophy. And understanding the philosophy is more important than understanding the tactics. The market is not a machine that calculates value. It is a machine that records human emotion. Every day, millions of people are deciding what things are worth based on how they feel. Fear makes them sell things for less than they're worth. Greed makes them buy things for more than they're worth. Benjamin Graham described this with a character he called Mr. Market. Mr. Market is your business partner. Every day, he shows up at your door and offers to either buy your shares or sell you his. Sometimes he's euphoric and his price is absurdly high. Sometimes he's terrified and his price is absurdly low. The brilliant insight: you are never obligated to trade with him. You can wait. You can ignore him entirely. You can let him be emotional while you remain rational. And when his fear makes him offer something far below what it's worth, that is when you act. Most investors treat Mr. Market as a teacher. They watch what he does and follow his lead. The value investor treats him as a servant, someone who occasionally offers extraordinary deals, but whose daily opinions are largely irrelevant. This changes everything about how you experience the market. When prices fall, when headlines say the market is crashing, when portfolios are down 20% or 30%, the average investor feels fear. They sell. They try to stop the bleeding. They wait for things to feel safe before buying back in. By the time things feel safe, by the time the headlines are positive again and confidence has returned, the best prices are long gone. The patient investor has already bought. The emotional investor is buying back at the top. This pattern has repeated itself with extraordinary consistency for over 100 years. And yet, in the middle of every crisis, investors believe this time is different. This time, the market won't recover. This time, the damage is permanent. It never is. The most consistent trade in financial history is this: Buy great businesses at fair prices when others are afraid, and hold them while others are impatient. There is something else worth saying about the psychology of having $100,000 invested this way. The value investor does not check their portfolio every day, often not every week. They have done their analysis, they understand what they own, and they trust the math to play out, not in days or weeks, but across years. This sounds simple. It is not. The human brain is wired to monitor threats. When your portfolio drops, your brain registers it the same way it registers physical danger. The instinct is to act, to move, to do something. Studies have shown something remarkable. The less frequently investors check their portfolios, the better their returns. Not because the market rewards ignorance, but because frequent checking leads to frequent action, and frequent action leads to frequent mistakes. The value investor's edge is not information, it is not intelligence, it is temperament. The ability to do nothing when everything around you is screaming to act. Buffett described his ideal holding period as forever, not because he's lazy, but because he understands that compounding, the quiet, mathematical, unstoppable force of returns building on returns, requires time, the way a seed requires soil. You don't dig up the seed every week to check if it's growing. You trust the conditions. You let it work. And here is perhaps the most uncomfortable truth of this entire conversation. Value investing is not exciting. It is not cinematic. It does not make for good dinner party conversation. There is no thrill. There is no chart to stare at. There is no story of getting in at the bottom and riding it to the moon. There is an annual report, a spreadsheet, a calculation, a waiting room, a holding period measured in years. And then, eventually, there is a portfolio that has quietly doubled or tripled, while the trader who was moving fast and feeling smart went through 3 cycles of profit and loss and ended up roughly where he started, minus the stress. The best investments of the last century were boring. Coca-Cola, Johnson & Johnson, American Express, Berkshire Hathaway. None of them were exciting when they were being bought. All of them were simply good businesses purchased at rational prices and held with extraordinary patience. The returns weren't in the genius of the idea. They were in the discipline of the waiting. So, why doesn't everyone invest this way? Because it requires the hardest thing in modern life, the willingness to be boring while others are being thrilling. It requires sitting still while a friend tells you they tripled their money on a hot stock. It requires ignoring the financial media that makes every market movement feel like a crisis or a once-in-a-lifetime opportunity. It requires being the person in the room who is not excited and being comfortable with that. We live in a world that has industrialized impatience. Everything is faster. Everything is louder. The entire financial media ecosystem is built on the premise that something important is happening right now and you need to react to it immediately. And every day, that premise costs investors money. The value investor has made peace with a different premise. Almost nothing that happens today matters to a business that I plan to own for 10 years. And that single shift in perspective, from daily to decadal, changes the entire emotional experience of investing. The market rewards patience the way almost nothing else in life does, because patience is rare. And in markets, what is rare commands a premium. So, here is how it looks, the full picture. $10,000 to $15,000 in cash and short-term treasuries, available, patient, waiting for the market to offer something extraordinary. $50,000 in 4 to 5 high-conviction businesses, each one studied carefully, each one purchased below intrinsic value, each one carrying a durable competitive advantage, each one held without flinching. $35,000 in the quiet, boring, essential businesses that nobody is talking about, the ones trading at discounts because they're not interesting enough to be exciting, the ones that will still be running in 20 years because they do something people will always need. No leverage, no options, no speculative positions, no chasing trends, no reacting to headlines, just ownership, real ownership of real businesses at rational prices with time as the engine. Here's what most people won't tell you about value investing. The hardest part isn't the analysis. It isn't the math. It isn't even finding the right businesses. The hardest part is believing when the market is telling you that you're wrong, that the market is the one that is wrong. Every great value investment in history went through a period where it looked like a mistake, where the price fell further after purchase, where friends and family wondered why the investor wasn't selling, where every signal said, "Get out." The conviction to hold, backed not by stubbornness but by actual analysis, is what separates the investor from the speculator. One is reacting to the market, the other is waiting for the market to come around to what the math already said. And it always does. Not always quickly, not always on schedule, but with the consistency of a natural law. Price follows value, eventually. So the real question isn't, where would a value investor put $100,000? The real question is, are you the kind of person who can actually do what this requires? Can you read instead of react? Can you hold when everything says sell? Can you wait when everything says move? Can you be boring when the world is being thrilling? Because the $100,000 is just the beginning. The real asset, the one that makes the entire philosophy work, is the mind you bring to it. The trader bets on what the market will do. The value investor bets on what the market has gotten wrong. One is guessing at the future. The other is correcting the present. And over time, over enough time, correcting the present is the most profitable thing you can do with money. Not because it's exciting, but because it's right.